Should I stay or should I sell now? That is the song of 2025. What are we going to do? Are we going to stay and keep that low interest rate that we have? Rate fatigue setting in? Or should we just finally sell and get the heck out of here? Make the next move into life, right? We're going to talk about that today. Consumer confidence, optimism, what's happening with spending out there. Let's get Mr. Dave D'Souza on from Glendale, California. Welcome aboard, Dave.
Well, good morning, Cash. As we're having an all-cash morning, I think I'm going to keep my mortgage banking career, but I think you ought to seriously think about a career in music. I really think
I'm coffeeed up this morning. I had a little
as successful as you are in real estate, I think you'd ought to do that with your Elvis.
Took my little Donovan for pancakes this morning, and they brought out the largest kid-sized pancake in the world. It's on my Instagram. I took a little video of it, and then I ordered, can I have a pancake instead of the toast? They brought me out a pancake this big. I was like, and just instead of a little slice of toast. No, it flopped over the plate onto the table. I was like, this has got to be a joke. I was waiting for the cameras to come out and they're like, oh, surprise. Didn't happen.
Nothing like a healthy, nutritious breakfast to get your Saturday going, huh?
Yeah, I ate half that pancake too. I mean, I went rolling out of there, just didn't half that pancake. And
let me guess, you saved the other half for lunch.
The place is called Hash House to Go-Go, or Hash House to Go. I'm sorry, Hash House to Go-Go. Not
you should have them change the name to Cash House to Go-Go.
I like that.
Yeah,
Cash House to Go-Go. Perfect. And my little Donovan and I, we're asking ourselves, are we foodies? What makes us a foodie? We love food. We love good restaurants. We love all of that. We're into it. We're passionate. But what takes somebody from that to a foodie, right?
Well, I'd say eating a pancake that size, you have automatically been inducted into the Foodie Hall of Fame.
The Hall of Fame of foodies, right?
Foodie Hall of Fame.
I think what takes someone from passionate about food and restaurants and the experience is when they put it on Instagram. You throw it on Instagram, eating something, now you're a foodie. That's it. That what determines you're a foodie. So anyways, Dave, let's get into real estate, man. People don't care about my pancakes. Let's talk about what's going on with interest rates, what's going on with consumer confidence, the CCL, the cash cost for lunch. Let's look into that and talk about all these good things going on. And then we're going to talk about consumer confidence and optimism and spending. So what are you seeing going on in the market right now with your interest rates today?
Well, let me just give you this last week with the New Year's Day holiday was a little rather flat, non-eventful week. Interest rates actually ended the week dead par flat from where they were the week before. We were at 6.75. It's still at 6.75 is our par rate.
No change. Okay.
There was a slight dip earlier in the week and then a slight worsening towards the end of the week. Net result, we closed business Friday of yesterday, literally dead flat from where we were a week ago. The stock market ended up about 0.5% lower. So that's also, if you look at the 2-week window, that's relatively flat because last week it was 0.5% up from the week before that.
Okay.
This week it was 0.5% down. So basically from 2 Fridays ago to yesterday, dead flat. Some of the things that were economic data that flowed into the numbers for last week. Number one was the jobless claims. Again, a rather uneventful week with the New Year's Day holiday. But jobless claims, which is the number of people that filed for unemployment, was not just lower than the previous week's filings, but also lower than expected. Good for the economy, good for the job market, not particularly good for interest rates. Another number, which is a number that we don't talk about too often, is the ISM Manufacturing Institute of Service and Management Manufacturing. It's the manufacturing index that tracks the volume of manufacturing and the pace of manufacturing, which has a lot to do with the economy. And that index was actually expected to drop from the prior reading. It went up. So while Wall Street lost a lot of ground just before the New Year holiday, with a lot of people unloading stocks for year end, Thursday and Friday, Wall Street rallied, ended up pretty much dead, almost flat from where it was the week before. So that's a recap of last week. Again, the last 2 weeks being relatively flat and rather non-eventful. I believe this coming week, we have the December jobs report coming out. That's a big ticket because everybody, based on what that number comes out, has a lot to do with what the Fed's view is on interest rates going forward.
Gotcha. And I think this softening of the jobs reports also increased the 10-year Treasury, right? Up a little bit from 4.55. Now it's about 4.6, I think we were talking about earlier.
Yeah, if you were to draw a straight line of the 10-year Treasury, which has a lot to do with interest rates over the last 3 months, you will see an increase. And specifically from early December to the end of December, there was a notable increase in the 10-year Treasury note. Yes.
Yeah, 4.6 now. So, which, just so everybody knows, the higher the 10-year Treasury goes up, the worse that's going to be for mortgage rates. So if you're looking and keep an eye on mortgage rates, every time that Treasury rate increases or stays level, not much going to be happening with the rates. Correct, Dave?
And just as a footnote to what Cash is talking about, it is the 10-year Treasury yield that you watch going up, not the price, because in the bond market, prices and yields go in opposite directions. So when prices go down, yields go up. When prices go up, yields go down. It is the yield that you want to go down. And that's what you want to watch, because 10-year Treasuries yields fairly well track with interest rates.
Hey, Dave, when is the Treasurer supposed to meet next? I'm sorry, Jerome Powell.
I know. Well, they had a meeting in December. I believe, if I'm not mistaken, their next meeting is in February. I don't have the exact date of it.
So we're really going to be rolling with roughly a 6.75 for all of January. I don't see much action coming down the line for any kind of reduction. Do you?
Well, here's how I would answer that question. The 10-year Treasury yield is basically interest rate. It correlates to 30-year mortgages and 10-year mortgage notes. The 30-year mortgage interest rates. That is going to be data dependent. Remember, 6.75 is where it is right now, but as we go through the month of January, there's going to be data coming out to do with inflation. There's going to be data coming out to do with the jobs market. What that data indicates, consumer confidence, CPI, PPIs, PCE, inflationary indices, manufacturing indices, jobs numbers, jobs growth, the jobs market. If those numbers indicate a softening economy, weakening jobs market, inflation coming down, we could see interest rates drop to 6.25 within the next month.
Yeah,
so it really all depends on the data. On the same token, if it goes the other way and inflation continues to creep up, the jobs market continues to get stronger, which is all around good for the economy, that could have an adverse effect where rates could go up. So again, it's really hard to predict what exactly is going to happen. I would say at this point, on a broader perspective, between now and June, I would stick to what I've said before, that right now we're in the 6.75 range. And if we get anywhere close to 6, I'll be happy.
I think 6 is going to be the number. If we could get to 6, or even if we start to
shooting
break
for 5.5, 5.25, 5%, that's a little unrealistic at this point.
Yeah,
that would take, as you said before, that would take something catastrophic like a pandemic or war or influenza or bird flu or something like this. But without barring any of those things, which are overall not really good for our country, we'd have to have some serious movement in the economic market as far as inflation dropping and jobs market softening and weakening to see an improvement even close to at or beyond 6% net rate.
All right.
As I said, if we could get back to 6.25 to 6, I'll be very happy.
Awesome.
And people at that point should be pulling the trigger on stuff. I don't think people should be waiting for the 5.75 and the 5.5. I don't think we're going to see that anytime soon.
Yeah. So Dave, talking about going forward here, optimism. I'm seeing more optimism. Seeing it. I'm hearing about it. I'm just feeling it. I don't know where you're at, but just even through the shopping season, a lot of malls were full. We had a lot of people out buying. Spending overall was up anywhere from about 4 to 6%, or some of the rates I'm seeing with some of the different credit card companies. And but overall it was about a 4% increase in spending for the Christmas holiday over last year. So that's a good sign. People are loosening up a little bit, spending a little bit of money, and that could be in part of the election is over. This is not political. Doesn't matter who you like, who won, but every time.
The very fact that the election is over.
They're just happy it's over. Yeah, it's over. Now we know where we're going, what we're doing. And statistics have shown that after every election, through like about a couple decades, home prices have always gone up. We've always had a pretty good year with home prices increases after an election, right after. So talking about that too, we're going to get into some numbers that some of the different Zillows and Redfins and the Fannie Mae, Freddie Mac, and everybody is predicting for home increases throughout the United States for 2025. But first off, too, talking about and segueing into from that into consumer confidence levels, I checked those out yesterday. The rate is up to 74. That's their indicator number for what's going on with consumer confidence, right? And that's up from 71, which is a 3.6% increase month over month, and a 6.17% increase from last year. So consumer confidence is up 6% over last year and 3% over last month. So, which, seems to be proof positive with people spending a little bit more money and, consumer confidence increasing and optimism increasing, So what are you seeing, Dave?
Well, I think your numbers that are in line with what I've seen. The only thing that what I could say is 2023 was a rather soft year all around. So an improvement from 2023 is good. But at the same time, I would offer that I think people are still being somewhat cautious because we are in a sort of a transitionary time. Interest rates have not come down as low as people might like. The other thing to bear in mind is, and I know you're comparing December to December, but also understand that December is always a bit of a skewed month from a standpoint of consumer spending and numbers because of the holiday season. So when you look at January, when you look at February, when you look at March, which are more normal months for spending, and compare those to what January, February, and March and first quarter were last year, that might be a little bit more realistic. But I would absolutely agree with you that numbers are definitely improved from what they were in 2023.
Thank you. Because we're talking about something totally different besides all the numbers, and this month to month is a slower month. And you can't look at, man. I see optimism. I hear optimism picking up, and that is so important because we're talking about consumer confidence, which I think is the most important key indicator out of all of them.
Correct.
If people aren't feeling it, they're not spending it. And
correct.
Yes, I don't think people have opened up their pocketbooks fully yet. It's still reserved. Yes. But there's a little excitement. I'm feeling a little buildup of excitement. I'm optimistic anyways, but I'm also a realist. So,
well, and to your point, all these numbers of inflation, et cetera, they're all driven by what people are spending. What people are spending is driven by, well, there's two forms, right? One is the needs, groceries, milk, bread, utilities.
Right.
But when it comes to non-essential items, if consumers are confident in the economy, if they're confident in their earning ability, if their overall confidence in the job market and the economy is solid, that is going to predicate their spending.
True. Absolutely.
And so to your point exactly, consumer confidence really leads all other sectors, because if you've got the majority of consumers out there who are waning in confidence, who are lacking in confidence in the economy, you will definitely see a substantial decrease in spending.
Right. Absolutely. So, how about you? Did you get out do any shopping, or was it all online shopping for Mr. D'Souza this year, or your wife?
Mr. D'Souza actually does his shopping by way. I'm very lucky that most of my family just likes checks so that they can go out and purchase their own gift. So it's even one step better than online. I literally just, write a few checks and it's guilt-free and everybody gets what they want. So that's kind of how Mr. D'Souza does it, which is a little.
You don't have to worry.
However, I do cards. I definitely do cards, which express my sentiment, but those are obviously not done online.
And you don't have to worry about wrapping presents or putting bows on them either. So there you go.
I don't. Right? I put the check in an envelope along with a nice little card. That's all she wrote.
Wow. So do you guys put any fake presents under the tree or anything? Do you guys do a tree? Is that
my family does presents.
Okay.
I've come to the conclusion that with the number of times that I've given presents that have been returned, I've literally been asked for just let us buy our own presents, Dad.
This year at our house, we had a couple people play that little trick on people where they, you got a big gift, big wrapped box. You tear that open, there's another box. Tear that open, there's another box.
Oh, good for you.
No, it was good for me.
I hope you didn't do that. I hope you're smart enough not to do that to Amy.
No. Somebody else did, though. Somebody else. That was my son.
Well, as long as somebody else that's not married to her, you're good.
Yeah. I think, what was it? About, I'm thinking about 12 boxes, I think. She was ripping, from this down to this, It's crazy.
Well, I'm sure after about 3 or 4 boxes, she got the idea of what was going on there.
And then Vandy threw, our stepmom threw one in there too. So that was crazy. That was fun.
Nice.
Anyway, it was like, wow. 2. So we had 2 that happened twice this Christmas. Anyways, consumer confidence up 3% from last month, 6.17% from last year, Dave. And that
definitely something to be optimistic about.
Yes. Yeah, and it's not just me being optimistic, because I had a nice breakfast this morning with my little, how was he? He's 5, my 5-year-old
Mega
this morning.
pancake.
Yeah, big pancakes. That always makes me happy. But no, just seeing that things are improving a little bit. I see improvement coming on. So I'm feeling good about 2025. And, you got Elon Musk in there. You got Dana White even throwing punches in there with the UFC and Trump and all these guys. And it seems like there seems to be, and there's going to be a lot going on. So who knows how everyone's going to accept and take and deal with these things, but it's going to be an interesting year, but I feel good about it anyway. So
I would guess overall this year is going to be a better year for the real estate industry than it was last year.
Okay, good. I appreciate
in
that.
In the same way that 24 was better than 23, I think 25 is going to be a better year than 24 was.
I think we're going to keep on going with that.
We're going to see more inventory. I don't know that we're going to see a whole lot of improvement in home prices, meaning prices going down. So for both buyers and sellers, especially buyers, if you're sitting there thinking you're waiting for prices to go down or rates to go down, definitely not what Cash and I are thinking.
No, I'm not seeing that at all. And based on these different analysts, we're going to talk about that right now, their numbers they came up with and speculations for 2025. But first, you were just mentioning inventory picking up. Inventory is up 27% from this time last year. That's a really nice increase in inventory. Yeah. And if you have a home you're getting ready to sell, and oh my God, 27%, that's crazy.
And just to give our viewing audience a perspective, that means for every 100 homes that were on the market this time last year, there's 127 on the market now, just to give you a perspective of what that number means.
Right. But we need more inventory. Inventory is healthy. More, not too much inventory, but we need more because we've just.
Let me ask you this: would you say with this 27% increase, where are we with what you might consider in your career as a normal inventory market? Are we
normal
there, or we're not quite there yet?
I've been in real estate since 2008, since the crash, and I don't know if I've seen anything normal, Dave. I don't know what the hell normal is. I'm not normal. I don't know. I'm sure my family and friends will tell you I'm not normal, but I don't know what a normal market is.
Is where the inventory is now above or below a healthy level of inventory?
I think we're getting just on the lower end of a healthy inventory. We're probably, if I had to pull a number out of the sky for like a national number, we're probably around 4%. Maybe some markets a little lower, like 3.5. I'm sorry, not percent, months of inventory. 4 months of inventory, maybe 3.5 to 4 months of inventory, maybe 4.5 months of inventory in some other markets. A little bit more inventory here and there, right? It's kind of scattered. But listen, just for context, about you get to that high 5-6 month mark of inventory, that's when you start to get a pretty good healthy inventory.
That's healthy.
Healthy, and then it starts to get to where it gets to be a buyer's market. You get to 6 months of inventory or beyond.
Okay, so 6 months is starting to be more in the buyer's favor. 3 months is a little bit more towards seller's favor.
Correct, absolutely. So we have been in a seller's inventory for quite a while, for quite some time, but that's starting to get up to where, and what it does, when we get to this kind of level, it just gives more buyers options. They need some things to look at, right? Because they haven't had any options for the longest time. So now they've got some options.
Well, sure. A higher inventory means they've got more homes to choose from.
And we're also kind of thawing out a little bit from this Cold War market that a lot of agents have been calling it, meaning this frozen, locked up market where a lot of sellers have not been coming forward because they have been locked into that 2.99 or 2.89 interest rate or 3%.
Oh, you mean interest rate prisoners? Yeah.
Interest rate prisoners. Yes. The interest rate fatigue is setting in, is kicking them right. Or that was a punch, right? Punching them right in the gut and saying, hey, it's time to maybe move forward with life and let's go ahead and figure out what we're going to do with the interest rate on the purchase side. Right. So
many of those people and many of those sellers that were previously willing to forego their dreams to hang on to that 2 or 3% something interest rate are now getting to the place where they're saying, maybe we're willing to let that go so we can have our dream home.
Absolutely. And another reason too, is that they just couldn't find any houses that they liked. Because, if you're going to make that next move, you want to really find a house that you like.
Correct. Especially if the interest rate's higher than you might like.
That's that added into the mix. That doesn't help at all. But if you find a house you really like, then you'll probably figure a way to work around that interest rate somehow, some way. But you got to find a house you really like to do that. That's got to be the motivating factor for you, right?
Correct. And now with an increased inventory, that probability of that is improved.
That's opening up the market more. Absolutely, 100%. So that's good. So don't freak out. We don't have some crazy plethora of properties coming out and inventory is just blowing up. It's just been picking up, and we're about 20. We need to be at a number like this anyway. So this is good. This is all around good. And coming out of that locked up Cold War market that we've had for so long, right? So inventory picking up. Just to give you some numbers for context, what's that? Did somebody say something? Oh no, okay. 650,000 now is what we have in our inventory, and last year at this time we're at 513,000.
Is this you're talking about nationwide? No,
nationwide.
Nationwide, yeah. Okay.
Nationwide. This time last year, 513,000 active inventory, and right about now right around 650,000. The inventory peak for 2024 got up to 739,000 actually, so that was pretty good.
Wow.
Yeah, but then that got gobbled up pretty quick too. So, all-time inventory low was in 2022 at 240,000.
Wow.
Yikes. Right? Okay. And that's across the whole country, right? And for context again, active listings in 2015, the high was 994,000. So
it sounds like maybe 750 to 800,000 ish is a good target healthy number.
Could you imagine that through the country? You've got 994,000 in 2015, and then 2022 you're dealing with 250,000.
Yep. Almost 75%.
You're looking for inventory. You can't find anything you really like. I mean, it's really tough, right? Then again, always depends on the demand, so the supply we see is low, but then if the demand's not there, then okay, it's kind of a wash. But if there's demand and low supply, this is where we get into the seller's market.
Right. Well, high demand with low supply is a recipe for inflation.
You nailed it, brother. You nailed it, Mr. Dave D'Souza.
Well, the good news is if we've got inventory improving,
yeah,
and the demand stays moderate, that might also help inflation in the sense that somewhat of a correction in prices too.
Right, absolutely. So again, we talked about the consumer confidence level up to 74 from 71, and I want to talk to you about the CCL. Okay, that is a really important indicator. Those numbers right there, the cash's cost for lunch. Okay, I'm out there all the time. I'm out there hitting the streets. We're doing real estate. We're talking to people, and I'm buying some lunches. And guess what? They haven't really gone down. They haven't gone up so much. It's kind of still flatlining right now where it's at, which has been kind of higher. Like we talked about, I used to be able to get a lunch for myself for $5, and then it was $7.50, $10, $12.50, $15. Now it's like $15 to $18 for lunch for just me. What is going on? Right? So anyways, that's what's going on with the CCL. Not a lot of play there right now. That's still staying the same. That's a good thing. I don't want to start seeing where I got to start paying $25 to feed myself. And I'm talking self-serve restaurants. I'm not talking about, waiters and waitresses and all that kind of thing. I'm talking about me going up to the counter and ordering myself, going to Whole Foods or whatever the case might be and getting some food.
What would help that CCL and what would help inflation come down is if that cost that tipped out at $14, $15 could actually come down to maybe $12. That would actually help inflation, which would ultimately help interest rates.
Okay. All right.
Now, if that's going to happen or not, that remains to be seen, but.
Gotcha. Yep. So anyways, that's where we're at. That's what's happening. And, I don't know. I'm excited about 2025 and inventory picking up, and I think it's going to be a good year. So
I agree with you 100%. I think 25 is going to be an all-cash year.
If you're out there thinking, should I stay or should I sell? Let's get into the equity chat a little bit, right? Let's talk about equity, because, I've had some people say, listen, I'm making, if my prices go up in my house, let's say 5%, okay? And I have $1 million house, but I owe 500,000. They had a thought that they're only going to make 5% on what they have already got in equity. So if they only have a mortgage of 500,000, they're thinking they're only going to make it on that. No. If you buy a house and you've got $1 million house, right? Doesn't matter how much you owe on it at all, and that goes up 5%. You just made 50 grand on that $1 million house, right?
Absolutely.
You didn't make 25 because you owe 500. You made it on the whole cost of the house. So if it goes up 10%, you made 100 grand on that house. So this leads to my thought on there are people out there that want to put large down payments on houses. And I get that. They want to have a lower monthly payment. And sometimes if that's your comfort level, absolutely fine. But Dave, what happens to that money when it sits in the equity in your house? It's not really doing a whole lot, right? You could actually be a VA buyer, do $1 down on $1 million house, because VA goes up to about $1 million or $1.1 million, doesn't it?
Yeah, well, it also depends on the client's eligibility, but and there are cases where it can go even higher than that with the 2025 limits. Yes.
Yeah. So can you imagine you could buy $1 million house, VA veteran, and put $1 down, providing everything else lines up for you, you know, DTIs and credit and all those good things, and buy a house. And then if that house goes up 10%, right? You just made $100K on that house. Turn around, sell it. Of course, you got some costs and some fees, but
here's the beauty of the practicality of what you just said. If two people bought a house for $1 million, one put 5% down and the other one put 50% down.
Right.
Granted, the one that put 5% down is going to have a much higher payment than the one that put 50% down.
Right.
But if 5 years from now, the value of that home is 1.2 million, they both made exactly the same amount of money.
Right. Right.
In other words, the person that put 5% down hasn't made any more or less money than the person that put 500,000 or 50% down. It really comes down to my suggestion to people is what I always tell people is put as little as possible down so that you are comfortable with the monthly payment.
Right. Yeah.
And then take the rest of the money and instead of putting it down on the house, invest it. Because then you're taking money that's just sitting in the house, not really doing anything for you.
Right.
It's the house that's doing the work, not the money you put into it.
Correct.
And then take that money and invest it, say, in the stock market or something else that's going to make you money.
Right.
The key to that being is whatever your monthly payment comfort level is should dictate how much you want to put down.
Right. Or if you're sitting there with a lot of cash in your equity, do a HELOC. You know, yeah, you're going to pay a higher interest rate right now. But if you had money out already or saved aside because you didn't put that much down in the first place, you got it there making, maybe it's in a CD making 4 or 5% right now, right? And it's totally safe, you know, so you don't have to refinance, do a cash out refi. You don't have to do a HELOC, a home equity line of credit to pull money out. So you can go invest in maybe another house, right? Maybe you can go get into the flipping business or buy and hold, whatever your comfort level is going to be there too. But that, at the end of the day, the money sitting in the equity is not doing anything except giving you a lower monthly payment, which with the high interest rate environment that we're in today, I get that too. You know, I mean, you got to have a comfort level with monthly, and that's what it boils down for a lot of people. They got to be able to afford that monthly payment, right?
Absolutely.
100%. So anyways, Dave, I'm excited, man. I'm optimistic. I'm excited. And
I'm right there with you. I'm ready to have an all cash year.
Speaking of that, all cash cities for purchases in 2024. We got the top 10. Where'd they go? Where's my list over here? Yeah, listen to this. Number 1 was Las Vegas, Nevada, where I'm at right now today. Actually,
you're talking about the number 1 city where people pay more all cash for houses than anywhere else?
Las Vegas, number 1. Tucson, Arizona, number 2. Number 3, Henderson. Henderson is 10 minutes from Las Vegas.
So Nevada, another Nevada.
Yes. It's right next to Las Vegas. So Las Vegas and Henderson, that's in the top 3 in Tucson, Arizona. Then you've got Orlando, Los Angeles, Phoenix, San Diego, and Fort Lauderdale, Jacksonville, Florida. And coming in last is Dallas, Texas. Texas. I can tell you.
Do you have any statistic on what is the city where the least number of home sales are all cash sales?
The least number, no.
Meaning the largest number of homes are people that take loans, or the least number of all cash sales.
You know, there is, and gosh, I can't remember where that's at right now. I did come across that one time. Yeah, we talked about that. So, but here's even a fun fact. I found a little fun fact to throw in there. United States population. What do you think it is right now? What's your thought? How many?
I'm going to guess maybe 330 million.
Woo! Wow. Give that man a cheeseburger. 337 million people in the United States right now.
It was 328 not too long ago, so it's gone up almost 10 million from that. Okay.
Okay. Wow. Very good, Dave. That's I'll give you a round of applause, man. Okay.
Well, you know what's another interesting fact? Again, not to turn this into political conversation, but literally a little more than half of that is the number of people that vote every year.
Half of that's the number of people that vote.
About 150 million a year is what people vote, more or less. Some years when there's more turnout, it's maybe 160, 170. But obviously there are younger people, there are extremely elderly people, and a lot of kids that don't vote. Yeah. But out of a population of 337, about a little more than half of those actually vote. Just a fun fact.
Here, let's roll into the next question and last question of the day for you. Okay, how many people? What's our population in the world?
The world, I'm going to guess maybe 7.8 billion.
You got Google open right now?
No. I mean, is it? I don't know what it is, but I'm going to guess based on progression. It's about somewhere between 7.5 and 8 billion.
Tell me you're not on Chat GPT or Google or something.
No. I'm looking straight at the camera. This is an all cash morning, no Google.
Okay. All right. Anyways, 8 billion people.
Oh, 8 billion. Okay, so it's gone up a little bit. Yeah.
8 billion creatures walking the planet right now. Well, hopefully most of them are walking anyways. That's what's happening on right now.
Well, two of us are having an all cash morning. I'm not sure about the rest.
We're all having an all cash morning.
I'm not sure about the rest of the 8 billion out there.
So talking about predictions, Dave, for 2025, there's a list of all these different analysts out there and different companies. And just to kind of throw a couple at you real quick going down there, existing home sales predicted by National Association of Realtors is going to be positive, up 9% for 2025. That's their prediction. Okay. Median home price up 2%. General home prices from Realtor.com is calling it up 3.7% for 2025. Mortgage rates. Realtor.com and National Association of Realtors (NAR) is calling for a decrease to 6.3%. So they're calling numbers of 6 for the lowest. It looks like to a 6.3 for 2025. And I think
which is pretty much in line with what we were talking about.
Yeah, that kind of lines up with what we were talking about, right? So they might be spot on with that. Housing inventory. Realtor.com is calling for 11.7% increase in 2025. Regional home sales growth by Investopedia, top metros, 13.5 to 27.1% increase. Let me look at the home price growth by Zillow is calling for a 2.6% increase. Existing home sales, Zillow, 4.3 million units. Redfin, home price growth. What are they calling for home price growth in 2025? Redfin is calling for 4%. 4% for 2025 increase in prices. Let's see. Goldman Sachs is calling for a 4.4% increase in prices. And let's see what Fannie Mae is calling for a 3.8%. Freddie Mac. Ooh, boo, Freddie Mac. They call for a 0.5% increase for 2025. That's just wah, wah. Anyways, home price growth average consensus with all these cats, throw them in the mix, 2.5% for 2025. What do you think about that, Dave? What's your thought? What are you calling for the increase in prices? Because all of these have a positive in it. Everything's a plus, a positive. We're going up. Everything's heading north. From a 0.5 point, it looks to a 4.5 is what we got.
I would say something in the 2% range would suffice, and that's it could go higher than that initially, and then maybe cool off later in the year, because one of the things that I think will have somewhat of a limiting factor on the growth in values and prices is the obvious interest rates. If interest rates were in the 2 and 3%, we'd have much higher increase in prices because people would be able to afford higher prices and still keep their payment where it is. Right. Remember, to be able to substantiate an increase of 2% more than, or 3 or 4 or 5% in home prices or the overall inflation, wages and income has to increase accordingly. If wages and income are not increasing accordingly, people just won't be able to buy, because if prices are going up and their wages are not, they will go back to those basic items that they have to have: utilities, a roof over their head, bread, milk, eggs, things like that. And then things like homes, cars, other items that are maybe a little less essential and things that people want to do, not things they absolutely need to do, will drop lower down on the priority list. So this is all going to be driven by wage growth and earnings growth. And just with everything the way it is right now, I think I'm anticipating somewhere between 1% and 2%, if that, increase in home prices, because anything greater than that, the consumer won't be able to keep up with.
Gotcha. My thoughts, my sentiments are we're probably going to get down for a 6 for a low, anywhere between 6 to 6.25. And I think we're going to see price increases about that time, probably going to be the latter part of the year or mid-year, latter part of spring to mid-year. And,
sorry, go ahead.
I'm calling it 4%.
In your recap, you just said, that they're calling for about a 10 or 11% increase in inventory. Mm-hmm. So a 10 to 11% increase in inventory, that's not going to help home prices. So if there was a very low increase in inventory, that might make home prices a little bit higher. So again, we're just speculating here, because at the end of the day, nobody knows what it's actually going to do.
Well, your speculation is saying, there's going to be an increase that's going to slow down purchases, but that's going to be all relative to the demand. Supply is one part of the issue. That's only half the issue. The other is the demand. If those rates, it's going to be indicative of the rates. Rates come down. And you know it, Dave, there's a ton of buyers on the fence. There's a lot of people want to buy, and there's a lot of sellers that want to make a move. So the combination of those two, but they're waiting on these rates to get down, and they're also waiting on inventory to pick up. Inventory's picking up. There you go. Right. Now we just got to get those rates in line.
Right, and that's what I'm saying is if inventory is going up, that means there are more homes on the market.
Correct.
If anything, that would support a smaller increase in prices because there are more homes on the market. But again, to your point, it all comes back to the balance of supply and demand. If there's an increase in inventory, but the increase in demand jumps faster than the increase in inventory, absolutely you're going to see home prices rise.
Yes.
If there's an increase in inventory, but the increase in demand is softer than the increase in supply, then you're going to see a lowering in prices. So it'll be interesting to see how this all plays out. But I'm going to ballpark in the 1% to 2% range is what we'll see if we see an increase in prices. I'm really hopeful that we see, regardless of what the prices, whether they stay the same, go up or go down, I'm really hopeful that we see a definite increase in activity.
Okay.
Increase in the number of transactions.
At the end of the day, you at least see a positive, a plus. Going north a little bit, you're calling 1% to 2%. I'm calling 4%. So, hey, there you go, folks. I hope that gives you some kind of an idea of what guys like Cash and Dave think here in the morning about what is going to happen with our market going into 2025.
Well, thank you for those statistics. Those are actually very good numbers for people to know.
Yeah, we got quite the variety there. And again, between all of them, between Fannie Mae, Freddie Mac, Goldman Sachs, Zillow, Redfin, and about 10 more, that they're all saying up. We're going up. So there you go. What are you going to do? Hope that helps. Anyways, Dave, let's say goodbye, man. Wrap this baby up. Until next time, watch out for the next video. And remember, if you want more cash in your life, make sure you go ahead and, oh God.
make it an all cash weekend. That's what I always say.
And remember, if you want more cash in your life, make sure you hit the button down below here and subscribe to the channel.
Already done, my friend.
All right. Dave, hey, let's wrap it up. I got things I got to do. I got a listing I got to get to. We're doing open house today and excited about that. I'm going down to California, Southern California, Santa Clarita. And I'm excited about that too. So anyways, great talking
and again, on behalf of you and myself and all of us here, and Amy, our producer, wishing all of you a very, very happy, blessed, safe, successful, and prosperous 2025. And we hope to be a part of that for you.
Likewise, Dave. Absolutely, 100%. So, and if anybody out there has wanted us to dig into some conversation and statistics and some information about any subject out there at all related to real estate of some sort or finances, just let me know and we will bring you the latest, hottest information off the presses, okay?
Yes, sir.
Until then, until next time, watch out for our next video. Thanks so much.
Thank you.